Listen very carefully, because what is happening in the silver market right now is being completely misrepresented, deliberately misunderstood, or flat out ignored by the mainstream financial media. You're being shown a price on a screen. You're being told that silver is volatile, that it's pulling back, that this is normal market behavior. But what nobody is explaining to you is the most important question of all. If silver is really trading where they say it is, why can't you buy it? Because this is no longer a normal market. What we are witnessing right now is not a rally, not a correction, and not speculation. It is a structural failure. A slow-motion breakdown of a supply chain that has been stretched, leveraged, and abused for decades. And the cracks are no longer theoretical. They are visible. They are measurable. And for the first time in modern history, they are happening while the world is still pretending everything is fine. On paper, silver is holding the line. It didn't crash. It didn't collapse the way they told you it would. In fact, by every traditional metric, you're richer than you've ever been if you own silver. But now comes the test that no chart can pass. Try to convert that price into metal. Try to take that number on the screen and turn it into ounces in your hand. Go ahead, call the largest online dealers in the United States. Call the wholesalers, call the mints, call the refiners. And listen carefully to what happens next. You won't hear a price quote, you won't hear availability. You'll hear delays, allocations, pre-orders, or worse, silence. Websites suddenly under maintenance, recorded messages citing extreme volatility. Shipping windows pushed out months into the future. This is not what a healthy market looks like. This is what a market looks like when it is trying to keep up appearances while the machinery behind the curtain is grinding itself apart. We warned you this would happen. We said that when silver finally broke through the paper ceiling, it wouldn't be clean. It wouldn't be polite. It wouldn't be a straight line up. It would stress the system so badly that the system would start protecting itself. And that is exactly what you're seeing right now. Because here's the uncomfortable truth. The silver market does not function on supply and demand the way people think it does. It functions on leverage, massive leverage. Paper claims stacked on top of a relatively tiny physical base. And as long as prices stay calm, that illusion holds. But the moment volatility spikes, the entire structure becomes unstable. Silver is one of the most thinly supplied, heavily shorted, and structurally important metals on Earth. It is not just an investment, it is an industrial necessity. Solar panels, semiconductors, EVs, medical equipment, defense systems, data centers, all of it depends on silver, and unlike gold, silver gets consumed. It doesn't just sit in vaults. Once it's used, it's gone. For years, we've been running a physical deficit. More silver leaving the system than entering it, lower ore grades, fewer new mines, higher energy costs, longer development timelines. This wasn't a secret. It was just ignored because paper could always fill the gap. Until it couldn't, and now the price has moved too far, too fast, for the paper system to absorb. This is why you're seeing margin requirements rise. This is why volatility is being blamed. This is why headlines are suddenly talking about cooling the market, not because silver is weak, but because silver is exposing risk that the system cannot tolerate. When exchanges raise margins, it doesn't mean demand disappeared. It means leveraged players are being forced out. It means contracts are being liquidated regardless of fundamentals. And every time that happens, it gives the illusion that the move is over. But the physical market doesn't care about margins. The refineries don't care about charts. The industrial buyers don't care about RSI. They care about delivery. They care about replacement risk. They care about whether they can secure supply for the next quarter, the next year, the next decade. And this is where things start to get dangerous, because refineries are not speculators. They don't want high prices. They want stability. Their entire business model depends on hedging. They buy raw material, refine it, and use the futures market to lock in their margins. They are not betting on silver. They are trying to neutralize price movement entirely. That system only works when price changes are manageable. When silver starts moving dollars in a day instead of cents, the hedge becomes a liability. Margin calls explode, cash requirements skyrocket. And suddenly, a refinery that is technically profitable becomes operationally paralyzed. They own the metal, but they don't have the liquidity to support the paper hedge tied to it. So what do? They stop buying. They halt new orders, they pause production. They wait for volatility to settle. And in doing so, they choke off the very supply the market desperately needs. This is the paradox of silver. The higher the price goes, the less metal comes to market, at least initially. And that's exactly what we're seeing right now. Wholesalers feel it next. These are the companies that turn industrial bars into retail products, coins, rounds, smaller bars. They operate on tight margins and just-in-time inventory. When refiners delay or cancel shipments, wholesalers are instantly exposed. They've already taken your money. They've already sold product they assumed they could replace. And now replacement is uncertain, so they do the only thing they can do to survive. They stop selling, they push delivery dates, they invoke allocation, they hope the price drops so supply loosens. Meanwhile, industrial buyers are doing the opposite. They are not waiting, they are not negotiating. They are not hedging the way they used to. They are securing supply at almost any price because for them, silver is not an investment. It is an input. If they don't get it, production stops. Contracts are breached, entire business models fail. So when retail buyers are hesitating, industrial buyers are stepping in aggressively, pulling large bars out of the system and locking them away. This creates a vacuum. Metal exists, but it is no longer available. And that's when price stops meaning what you think it means. Because at that point, the market goes bid only, buyers everywhere, sellers nowhere. The screen might say one thing, but the real price is whatever someone is willing to pay to pry metal loose from someone who doesn't want to sell. This is why premiums are exploding. This is why availability is shrinking even when price pulls back. This is why waiting for a dip is becoming a losing strategy. Because the dip exists on paper, not in reality. And now we need to talk about the most dangerous part of all, counterparty risk. If you don't hold silver in your possession, you are relying on someone else's promise. A dealer, a fund, a custodian, a clearinghouse. And in times of stress, promises are exactly what get broken. Force majeure is not a conspiracy theory, it's a legal clause. It allows contracts to be settled in cash when performance becomes impossible or impractical. Extreme volatility qualifies. Supply chain failure qualifies, and when that clause is triggered, ownership turns into settlement. Cash settlement at a price they choose, that is the escape hatch built into the system. And the closer we get to a true physical shortage, the more tempting that hatch becomes. This is why the divergence between paper and physical matters more than the headline price. This is why access matters more than charts. This is why the question is no longer how high can silver go, but who will still be able to get it. We are approaching the point where silver stops behaving like a commodity and starts behaving like a strategic resource. When that happens, price discovery moves away from exchanges and into private negotiations, into long-term contracts, into backroom deals between governments and corporations. Retail is last in line. That doesn't mean opportunity is gone. It means the rules have changed. Silver doesn't move in straight lines. It compresses, it frustrates, it shakes people out. And then it reprices violently. Every major silver bull market in history looked insane before it looked obvious. This one will be no different. The difference now is that the world is far more dependent